So raise your hands if you can relate to this picture. Everybody says that Tesla's price is overpriced. So what we mean when we say that Tesla is overpriced? Basically what we are saying is that the Tesla's price is way too high as compared to its valuation. For perspective, here is the stock price of the Tesla, the earnings, the EPS the Tesla was earning, and the PE ratio of Tesla during a long period of time from 2012 to 2022. As we can see, the highest PE ratio which Tesla had was in 31st December 2020 when it had a PE ratio of 1120. Guys, I'm not talking about the price of Tesla. I'm talking about the PE ratio. The EPS, that is, the earning per share of Tesla at that time was only 21 cents. However, the price of Tesla was $235. Since then, smarter heads have prevailed and the PE ratio have fallen drastically, and so does the price of the company. Now, the PE ratio of the company is 53 times of its annual earnings. Now, when we say that the price of the Tesla was high, we usually compare it to its current PE ratio. Here is the thing when it comes to valuation of the company or to know that the share is underpriced or overpriced. It is based on a huge myth. One of the biggest myth which majority of people have with regard to stock prices are that they are random. However, let me assure you that is not the truth. There is a method to this madness of stock prices. And this is done through valuation of the company. In fact, I have a whole course where I teach in depth how to value stock of any company in any part of the world. Here is a very small gist. Let's say you want to value or calculate the intrinsic price of Coca-Cola today. What are the ingredients you need to do that? The first one is free cash flows. What do you mean by free cash flows? It means what are the free cash flows Coca-Cola as a company will generate during its lifetime. Now understand this. Lifetime literally means lifetime. It doesn't mean 10 years, 20 years, or even 50 years. It means that how much cash flows company will generate till the time it will die. Now the next question arises, how the hell can you value something if you don't know its lifetime? Like you and me cannot predict how long the Coca-Cola company will last. For that, the next ingredient we need to value company is time. But like I said, we do not know the time period for which Coca-Cola will last. It can be infinite. So how will you take infinite time? So what you will do when we are trying to value companies using infinite time is you divide time in two phases. What are the two phases? Phase 1. Phase 1 is the phase where company cash flows are growing. And phase 2 is the phase where a company will stop growing or it will grow at a very constant low rate. Right? So basically what we do is we divide the time period between two stages. First the growing stage and the other is when the company will become stagnant. Next, we have to think of the growth rate. Growth rate in that time period. That is the growth rate by which the free cash flows of the company will grow in future. And like I said, future is divided or the time period is divided in two phases. Phase 1 where there is growth and phase 2 where there is limited or stagnant growth. And finally, we took something what we called a discounting factor for our cash flows. So just for a recap, ingredients for valuation of any stock in the world are the free cash flows, the time period, the growth rate in that time period, and the discounting factor. So let's take a very simple hypothetical example to make you understand this better. These are the four ingredients we required, right? Free cash flows, phase 1, phase 2, growth period, and the terminal value basically means that period where the company will stop growing or it will grow at a very low, constant, stagnant rate. Third is the growth rate in this time period. And the fourth is something which we call discounting factor. So let's assume that we are calculating our time period first of all is 0 to 10. That means we are assuming that the phase 1 time period will be for 10 years and the phase 2 time period will be from 10 years to infinity. So, first of all, we will need what? We will need our growth rate. Growth rate in two stages. In the phase 1 growth rate, that is for 0 to 10, let's assume that it is 8%. Now, I'm assuming a lot of things. When you will value real world companies, these numbers will change drastically. But this is right now to make you understand how the concept of valuation works. So let's assume that for the first 10 years, the cash flows will grow at the rate of 8%. And after that, after the 10th year, till the infinity, the company will grow at a very nominal terminal rate of 1% only. So what we will do, the third stage will be, we will take the free cash flows using these growth periods. So free cash flow to firm, let's assume that in the right now currently, the company is earning 100 rupees or $100. In the next year, it will grow by 8%, the free cash flows, it become 108. In the second year, it will grow 108 will grow by further 8%, that is 116.64, and so on, till the time of 10th year, where we get the free cash flow to firm of 10th year of $215.89 or 215.89 rupees. Now comes the difficult part. How to calculate the value of the company when the company will be growing at 1% infinitely. That is the terminal value of the company. To do this, we take the help of mathematics. Do you know that you can calculate the value of any infinite time series also? See, this 0 to 10 is one time series, and 10 to infinity, that is after 10 years to infinity, is another time series. So the value for calculating, or the mathematical formula for calculating the terminal value of an infinite time series is very simple. What is the formula? The formula is we will take the 10th year cash flow. We will multiply this 10th year cash flow with the terminal growth rate, that is the rate at which the company will grow infinitely, that is 1%. We will divide this whole amount by two things. First, we will take the discount rate, that is 8%, and we'll deduct it by the terminal growth rate, that is 1%. When you do that in our formula here, in our time series here, what we do is we take the 10th year, we multiply it with our terminal rate, that is 1%, and we divide by our discount rate minus terminal growth rate. This gives a figure of 3,115. That means after 10th year, till the time the Coca-Cola will exist or this company will exist till infinity, that value with this 8% discount rate and 1% growth rate is 3,115. This is how you calculate terminal value or the infinite value of a company once the growth becomes stagnant. The next step is discounting factor. Now I kept on saying discounting factor. What is this discounting factor? This discounting factor is, for a simple term right now, let's assume, is basically the cost of capital or the cost of funds which an investor expects when invest in any company. How this discounting factor is calculated is a huge exercise, and I have discussed it in depth in my valuation course. But right now understand that this discount rate for our purposes today is just 8%. So is this 8%? How do you calculate in the future this discount rate? Well, this discount rate is just the opposite of a compounding rate. So what we do is we take 1 divided by 1 plus discount rate, and what it gives us is 0.93. It basically means 1 year down the line, this free cash flow of 108 rupees basically becomes 100 rupees. And you see a very fantastic thing here. Since the compounding rate and the discount rate is same, the discount value of the cash flows in the future, for example, let's say 6th year, Coca-Cola or this company is earning $158. Since the free cash flow, since the growth rate is 8% and the discount rate is also 8%, the cash flow value in the future, if taken today, is still 100 rupees. See, we are calculating value not after terminal value. We are calculating value today because we want to take the decision today. So to take the decision to, if we don't have to take the decision today, and we were just saying that how much cash flows the company will generate, depending on our assumptions that the growth rate for the period is 10 years, and the company will grow at 8% during these 10 years, and after terminal value, that is on terminal period, the company will grow at 1%. On that basis only, the future free cash flows of the Coca-Cola or this company would be $4,679 or 4,679 rupees. But we want to purchase the stock of this company today. So how do you compare a comparable future value with today value? You do that by discounting factor. So when we are doing this discounting factor, what we do is just the opposite of compounding. We did 1 divided by 1 plus 8%. For the second year, we'll take this figure and again divide it by 1 plus 8% and so on and so on. Since the growth rate and these are same, that is why it is different. Let's assume that the growth rate was only 7%. Let's assume the growth rate was 8% and our discount was 7%. What will happen? What will happen is this discounted cash flows value will increase. See, from 100, it becomes 100.93, it becomes 101, 102. So the 100 increased, right? This is the power of having a low discounting factor. And if I take this a higher amount, what will happen? It will reduce from 100. See, from 100 it becomes 99, 98, 97. The value of the company as a whole decreased if the discount rate increase. So for future purposes, let's just convert it back to 8%, and we get the complete figures. And this terminal value will be taken as after 10th year 43. That is, this is taken 9th year. We again discounted to 10th year, and again we discounted to the terminal value. After 10th year, we will assume the terminal value for that year will be 46. Again, we are not taking the 11th year. We are taking the value of all these terminal cash flows in the 10th year only. So that comes out to be 1442 after discount. So the net present value or the value of the entire company becomes 2,335.98 rupees. Now let's assume that this number of shares that were outstanding of this company is 100 number of shares. So the value per share of the company becomes 23 rupees. And let's assume that the market price is 30. Then we say that the share price of this company is overvalued. And if it was different or ulta, let's say it was totally opposite. If the value per share was coming 40 and the market price was 30, then we would have said the share price is undervalued and it's a good investment. So this is how basically valuation works. Now, there are lots and lots of in-depth, there is lots and lots of real world companies which are valued in my valuation course, where I not just take this MOAT concepts, but also the entire way the company are valued in real life. If you want to check it out, the link is in the description.